Today we've got a deep dive into an ETF that's captured the attention of many, a popular option for dividend seekers, the Schwab US Dividend Equity ETF. Sure, it sounds tempting. It's got diversity, it's focused on large-cap US companies, and hey, who doesn't like dividends, right? But hang on a minute. Is it really the best place to park your hard-earned cash for strong returns and high yields? We'll compare this fund to other giants in the ETF world, like the SPDR S&P 500 ETF Trust and the Invesco QQQ Trust, both of which have been yielding stronger performance over the years. We'll also dig deep into the nitty-gritty metrics of Schwab's offering and examine its overall portfolio structure. But that's not all. We'll go beyond the basic comparisons and look at factors like flexibility, risk diversification, and total returns. Yield plus capital appreciation, because let's face it, a well-rounded portfolio is the key to long-term financial health. Then, we'll also explore some enticing alternative strategies. Interested in better income streams? What about the balance between active and passive management? We've got you covered. So if you're contemplating whether the Schwab US Dividend Equity ETF is the right investment vehicle for you, or if you're just hungry for more investment knowledge, you won't want to miss this video. Big shout out to Seeking Alpha for sponsoring our video, and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. While exchange-traded funds, ETFs, have emerged as cost-effective and versatile platforms for diversification in the investment arena, finding the right ETF that outperforms the market can often feel like searching for a needle in a haystack. Schwab US Dividend Equity ETF is a widely known investment option that targets dividend-paying US-based companies. Although it promises some level of cash inflows and risk mitigation, a closer look suggests it may not be the best choice for yield-seeking investors or those aiming for strong returns. The Schwab US Dividend Equity ETF aims to attract a specific type of investor, one who is interested in American companies that provide dividend payments. The ETF leans towards large-cap companies, with the average market capitalization of its holdings around $148 billion. Its investment style is largely value-oriented, which becomes evident when examining its valuation metrics like a price-to-earnings or PE ratio of approximately 13.9 and a price-to-cash flow ratio slightly below 9. One area that deserves further scrutiny is how Schwab US Dividend Equity ETF stacks up against other well-known ETFs. Let's take the example of SPDR S&P 500 ETF Trust, SPY, and Invesco QQQ Trust, QQQ, which have shown superior performance. Both SPY and QQQ offer greater exposure to growth sectors like technology, which have historically shown robust growth rates. Technology companies such as Apple, Microsoft, and Google have consistently generated impressive returns for investors. Their absence from an ETF focusing on dividend yields can deprive investors of this growth advantage. Its main objective is to closely mirror the performance of the Dow Jones US Dividend 100 Index. Data over the past decade shows that it has indeed closely tracked this index, even outperforming the broader large-value stock category by 33%, according to Morningstar metrics. Another point to consider is the agility of an investment vehicle to adapt to market conditions. By its very nature, the Schwab US Dividend Equity ETF aims to track the Dow Jones US Dividend 100 Index, meaning that it inherently lacks the flexibility to pivot towards sectors or stocks that could offer higher yields or returns. Its rigid focus may hinder its ability to adapt to shifts in market trends or economic conditions, possibly impacting its long-term performance negatively. The ETF is heavily invested in the industrial sector, which makes up 18.1% of its market capitalization, followed by healthcare, financials, consumer staples, and information technology. While the ETF has over 100 different holdings, more than half of the fund's value is concentrated in its top 15 holdings. For instance, Amgen, the largest of these, accounts for about 4.45% of the ETF. What's surprising, however, is that among these top 15 holdings, only Verizon Communications yields 5% or higher. The current yield of the ETF stands at 3.44%, which, though higher than the S&P 500's yield of 1.53%, is still lower than the 4.38% offered by 30-year U.S. Treasuries. When it comes to performance, the ETF has lagged behind other key market indices. Investing $10,000 in the SPDR S&P 500 ETF Trust 10 years ago would result in approximately $31,268 today, whereas the same investment in the Schwab US Dividend Equity ETF would be worth around $29,208, a difference of 7.1%. If we examine the Invesco QQQ Trust, the difference is even more staggering, with an outperformance margin of 79.1% over the Dow Jones US Dividend 100 Index. The ETF has also missed out on various companies that offer higher yields, such as AT&T with its hefty 7.37% yield. Furthermore, it doesn't include sectors like real estate investment trusts, REITs, master limited partnerships, MLPs, or business development companies, BDCs, which could offer diverse and potentially more lucrative opportunities for yield. While Schwab's ETF may seem diversified with over 100 holdings, it's worth noting that more than half of its value is concentrated in the top 15 holdings. This semi-concentrated approach may expose investors to a higher degree of specific risk should any of these leading companies underperform. On the other hand, other ETFs may offer a broader distribution of investments across sectors and companies, thereby offering a more balanced risk profile. While the primary aim for many investors in this ETF is to secure a reliable income through dividends, an optimal investment should also offer robust opportunities for capital appreciation. This is where Schwab US Dividend Equity ETF fails to excite. Its underperformance compared to other leading indexes also translates into lower capital growth. Therefore, investors focused solely on yield might miss out on the compounding benefits that capital appreciation can bring over the long term. So, what are the alternatives? Investors focused on dividends might look into dividend growth ETFs that invest in companies with a history of consistently increasing their dividends. These ETFs offer the promise of rising income, unlike funds that focus primarily on yield, which can see income levels remain flat or even decrease if companies cut dividends. Another strategy might be to consider fixed income investments. While traditional 30-year U.S. Treasuries offer lower yields, they come with the U.S. government's backing, thereby providing a more secure income stream. For more adventurous investors, emerging market bonds or high-yield bonds offer both a higher income and diversification benefits, but come with increased risks. The debate between active and passive investment management is age-old, but worth revisiting here. The Schwab US Dividend Equity ETF is a passive investment vehicle aiming to replicate the performance of its benchmark index. However, given its limitations in performance and yield, investors might consider actively managed funds that aim to outperform the market, though at a potentially higher cost. In summary, while Schwab US Dividend Equity ETF may seem like a decent investment choice for those looking for some level of cash distributions, it falls short of being an optimal investment channel for most investors. Those seeking higher yields might be better off considering US Treasuries, while investors aiming for better overall long-term returns may find more value in alternatives like the SPDR S&P 500 ETF Trust. While the Schwab US Dividend Equity ETF certainly has its merits, particularly for those seeking some level of cash payouts, it's crucial for investors to weigh its limitations carefully. Whether it's the ETF's lackluster performance compared to other key market indexes, its limited scope for capital appreciation, or its rigid structure, several factors suggest that it may not be the optimal investment vehicle for many. Given the myriad investment options available, from other better-performing ETFs to high-yield bonds and individual high-yield stocks, investors have ample opportunities to find more fitting avenues for both strong returns and attractive income streams. Therefore, Schwab's US Dividend Equity ETF should be considered as just one among many tools in an investor's toolkit, rather than a one-size-fits-all solution.